I just made a fart noise. Welcome back to Strongman Personal Finance. We got to talk about a stock that's near and dear to my very strong, healthy, often worked out heart muscle. Dropbox, or as I like to call it, fart box. Get it? Fart box. Why? Why do I like Dropbox so much? Well, there's two reasons. Number one, I actually use the service. I pay $11.99 a month, $12.99, something like that. I pay for Dropbox. You can upload your stuff to the cloud. You can share it with people. You can download stuff. And oh, by the way, if you want to have a one-on-one with Strongman or you want to buy one of my seminars, bro, there's a Dropbox link in the description of my videos. That's right. It's a great service. But does that mean that Dropbox is a great stock? Now, the second reason I like Dropbox is because Jeremy Lefebvre, is that Pay? Likes the stock. I don't know why, but he does. Let's go ahead and check out the earnings. My yearnings. I'm yearning for some Dropbox earnings, okay? Well, before we do that, let's look at the stock. So Fartbox is basically down 1% today, okay? The market apparently took a dump, but whatever. Dropbox is only down 3% in the past year. And over the past 5 years, it's down 17%. So basically, you haven't made much money from Fartbox, okay? How unfortunate. I wonder why. Let's go look at the earnings. Fourth quarter revenue of $600 million, up 6% year over year. On a constant currency basis, up 9.2%. Net cash provided by operating activities of $194 million and free cash flow of $181 million. Now, this is kind of like a Palantir situation. We'll see in a second, okay? When a company talks about their cash flow from operations and free cash flow, but doesn't necessarily always talk about profitability on a generally accepted accounting principles basis, it's usually an indicator of stock-based compensation, okay? Or they have a lot of non-cash expenses, depreciation, amortization. But with these tech companies, they don't really have a lot of depreciation. They may have some amortization because intangibles. But the big problem with a lot of these tech companies is stock-based compensation, which with GAAP it basically shows the cost of companies giving stock options to employees. So they don't have to pay them in cash. What a freaking joke, okay? So overall, revenue's growing. It's basically growing at the rate of inflation. So in real terms, 0%, maybe a little bit higher than inflation. Nothing too crazy there, okay? Great product. Not such a great investment, okay? At least in my opinion. So let's go ahead and look at the financials, okay? Because at the end of the day, I don't like reading what the company has to say unless you're like, there's some metric that you like to pay attention to. I don't like reading this crap because it's just them trying to highlight the good parts of their earnings and ignoring some of the bad parts, okay? So first, we're going to look at their consolidated statement of operations. Let me make sure I'm sharing my screen. Okay. So this quarter, revenue, like I said, $598 with gross profit of $483. Why is their gross profit so high? I mean, what is their cost of goods sold? The servers? I mean, they have very high gross margins. Their gross profit was $483 divided by $598, 80.7%. That's pretty good, okay? Now we look at their historical gross margin. I'm pretty sure that's within the normal bounds. Yeah. Their gross margin's actually improved over the past couple of quarters. So it's pretty good, okay? So their gross margin, there's no major red flags there. Oops, wrong one. All right, let's see some other things. So R&D has gone up. Sales and marketing has gone down. General and admin is basically flat. And we have a special item here. Impairment related to real estate assets. What does that mean? When you see the word impairment, they are writing down the value on the balance sheet of a real estate asset. Why? I don't know what they're doing with it. I don't know how they got to that conclusion, but basically they're writing down the value of that asset on the balance sheet. There is a calculation where you look at the future cash flows of an asset that you've capitalized and you say, are these cash flows, going to be more than the fair value or less than the fair value or whatever. But there's a whole process. I don't do this for my day-to-day job, but there's a whole process where they figure out whether the asset's value on the balance sheet actually reflects its value. In accounting, you can write stuff down, but you generally don't write stuff up. So in this scenario, they had some real estate assets and they wrote them down. It's a non-cash expense. So what you should see is an add back on the statement of cash flows. That is a non-cash expense, okay? And if it is, tickle me pink. So they had a loss from operations. But if you take out this impairment, they would have had basically the same income from operations as the prior year. So this loss isn't necessarily the end of the world for Fartbox, okay? It was that impairment of real estate assets. That is the main reason that they have a loss from operations. Keep that in mind. All right. And of course, their R&D has gone up. How much has their R&D gone up? 238 divided by 201. So they have 18% growth in research and development. So their research and development has outstripped their revenue growth. So that's just something to keep in mind, okay? But nothing crazy. I mean, they still would have been profitable on an operating basis if it wasn't for that impairment. All right, they got a little bit of interest income, a little bit of interest expense. Okay, nothing too crazy there. And their, let's see, net income, benefit from income taxes. Okay. So basically, they got a tax benefit, and that's why they're profitable. So basically, they had like some losses in the past, and they're using those tax benefits to basically show a gap profit, okay? But without that benefit from taxes, they wouldn't have been profitable. Keep that in mind, okay? So let's keep looking down, okay? Next, we have stock-based compensation. And a big part of the R&D expense growth is from stock-based compensation. Look at that. We'll go see their total stock-based compensation, okay? Let's see. Okay, so let's look at their balance sheet real quick. So cash down, short-term investments flat, trade receivables up a tad bit, prepaids up. So basically, some of their current assets have gone down. They have 1.4 billion of current assets. Let's compare that to current liabilities. They have 1.1 billion. I don't think they're imminently going to go bankrupt, and they have the vast majority of their current assets are very liquid. Short-term investments, you can sell those, convert them to cash. Trade and receivables, you're just waiting for people to pay you, and a very small amount of prepaid. So they have a pretty solid balance sheet when it comes to short-term assets versus short-term debts. A lot of their short-term debt as well is deferred revenue, which means they were paid in advance and they have to earn the revenue, basically. They have to provide the service. So over time, that 702 is going to it's going to leave the balance sheet and it's going to hit the income statement. Okay. So overall, I don't think they're going bankrupt in the next year, personally. Okay. A huge part of their current liabilities are deferred revenue. Long-term assets, what do we got? Property, plant, equipment went down a little bit, probably depreciation and the impairment. Actually, it was probably all the impairment. Operating lease right of use assets. Okay. So in accounting, you have to put lease. When you have a lease, you have to put it on your balance sheet as an asset and a corresponding liability. So their leases went down. That could have been, amortization or whatever. Intangible assets went up a little bit. Goodwill went up. They had an acquisition, some kind of acquisition. Deferred tax assets. A deferred tax asset is basically saying that if you pay a lot of taxes now and you're going to basically recuperate or reverse that in the future, you put it on your balance sheet as a deferred tax asset. Basically, there's different rules between accounting, like GAAP accounting, and tax. And those differences sometimes are temporary, and that results in companies putting deferred tax assets. So basically, they're going to recognize a huge tax benefit for whatever reason. And that's a huge increase, by the way. I guess they, I don't know. I guess they took they had a huge, they weren't able to take as many deductions on their tax form as they were on their income statement. And that's why they have a deferred tax asset, because at some point in the future, they're going to get a huge tax benefit for not being able to take that now. It's kind of complex, But basically, deferred tax assets are a real thing, and they will result in future tax savings, okay, because of temporary differences. So overall, solid balance sheet. I mean, they've been writing down real estate, but it's not going to kill the company. Okay. Let's see. So I got operating leases for debt, long-term debts, financing leases, convertible senior notes. They have 1.3 of convertible notes. I wonder when those are due. That would be a good thing to look at. And other non-current liabilities. So overall, their balance sheet ain't that bad. Now let's look at the equity section. Additional paid-in capital has gone up, stock issuance. Accumulated deficit has gone worse, so they've had losses, or maybe they're doing share buybacks, actually. That's probably what it is. And accumulated other comprehensive loss. So overall, the only reason their equity has gone up, stock issuance. Okay. And actually, their equity's gone down. The funny thing is they have a total stockholders deficit. Okay. So they actually have more debt than assets. But of course, a big part of that is deferred revenue. So keep that in mind. Okay. But I don't think they're imminently going to go bankrupt. Now, let's look at the statement of cash flows. This is where you can see all those non-cash expenses that Joseph Carlson just hates so much. Oh my God. Okay. So we have stock-based compensation is $87 million. So stock-based compensation in the last 3 months was roughly, let's see, 87 divided by 598 was roughly 15% of revenues. Okay. So when you look at Dropbox, you're like, oh, look at our cash flow, bro. We got positive cash flow. Well, if you had to pay your employees with more money, you had to pay them in cash instead of stock options, your cash flow wouldn't be as great now, would it? Oh, but we have cash flow from operations. Okay. So they have an impairment. Okay, this is the impairment. See, exactly. They added it back. Okay. Deferred taxes, that's a subtraction. So overall, you see these differences, right? Huge difference between net income and cash from operations. And that's because of all these non-cash expenses or gains. Okay. They had a huge write-up for deferred taxes. That's why they're subtracting it. It was a non-cash write-up gain, whatever you want to call it. And that's why it's being subtracted. So it made their profits look really, really good. But in reality, their profits really aren't that great, at least from a GAAP perspective. Okay. So overall, they have positive operating cash flow. I mean, they're not going to go bankrupt as long as, they continue to dilute and shareholders don't care, whatever. They can just dilute and issue stock. Here's more stock options, blah, 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 blah. It's a freaking joke. Okay. All right. They bought another business. That's where the goodwill came from. And then overall, they are buying back stock. See, that's why their accumulated deficit is getting worse. And I didn't know this. I actually learned this. Like, I was doing a video like 6 months ago, and I was like, they're making profits. Why is their retained earnings going down? That doesn't make sense. And it's like, well, it's not a dividend, right? Oh, there's a certain type of accounting where if you buy back stock and you retire it, you actually have to debit out retained earnings. You have to reduce retained earnings. Okay. Well, it's all technical crap. But at the end of the day, they're underwater when it comes to assets and liabilities. I'm just saying, okay? And they're buying back stock. Basically, they're paying more for the stock that they're buying back than they originally issued it at. So they're giving out stock options to their employees. The employees exercise the stock options. And then Fartbox goes out there and they buy back the stock to kind of like make sure there's not like massive dilution. And they're buying back those shares at higher prices than they initially issued them out. So that's kind of my assessment. This company is just another tech turd. That's all it's a tech turd. Like, they just issue shares and they buy back the stock. And they have, I don't know. I don't know why people are so obsessed with these companies. Oh, it's tech. And it's not even growing that fast. I mean, it's barely profitable from an operational standpoint. Very not very profitable from an operational standpoint, and it has a decent amount of stock-based compensation and dilution. I don't see like the massive appeal of Dropbox. Great company, great service, kind of a turd of a company, okay? But you know, there's value in everything. Let's see. Dropbox, my soapbox. That's right. I'm on my soapbox right now. What's up, brother? What's up, Joel? How you doing? Dropbox, my meme stocks. Put a shirt on. Let's see. I can't wait to see what Kid Freshie has to say tonight. Apparently, I'm not allowed to look at financial statements. Okay, apparently, I don't believe in index investing because I look at financial statements. Oh, you know, by the way, everybody, I just put $2,000 into my IRA. Well, total of $2,000. I put $1,000 in my IRA and $1,000 in my wife's IRA. And you want to know what I bought? VT Maiti. That's right. I got $2,000 of VT, my delicious ET today. Yeah. I'm a fake boglehead. That's right. Dropbox more like Moonbox. Let's do stock-based compensation, and then we'll just buy back the shares, and then we'll have less assets than liabilities. Okay, it'd be wonderful. Stock-based compensation encourages employees to work in the best interest of the company because it has a direct impact on how their compensation will be worth. Well, apparently they ain't working that good because the stock hasn't done that great, okay? Inflation was 16.2%. That seems kind of high. I don't believe that. Here he is, Mr. Accountant, Mr. Tax. How you doing, brother? You surviving? Nobody uses Drop. I use Drop. I think it's great service. I like Dropbox. Actually, I pay for it. I'm part of the reason they had revenue growth. Thank you. You're welcome, Dropbox. You will lose everything on Dropbox. Dropbox is the next Google. I mean, there's so much competition in the cloud space. Like, there's so much competition. I mean, I personally I was just using Dropbox for a long time. And eventually I was like, you know what? I'll just pay for it because, you know, I got to like store stuff, a lot more stuff on there, and it's kind of useful, and it's kind of nice to have like stuff backed up in the cloud. So eventually I started paying for it, but like that's just because I've been using it, and I think it has a better interface than Google. Google offers some kind of cloud service, but like I don't like how it's structured. I don't know. I'm used to Fartbox. Everyone will be wiped out in 7 days. Strongman's last warning. I need to start titling my videos like that. I'll get rich. Why aren't you doing taxes, boy? I am. I got one hand over here doing taxes. Okay. Dropbox is such a useless company. I think it's a great service. I really do. Because you can all your files can just go on Dropbox and you can organize it. And if you need a file, boom, you got it saved there. Like all my taxes, right? All my tax stuff. I put it on Dropbox. It's all saved up there. So if I need to go see, let's say I get audited, right? In 5 years, I have all my tax stuff right there in a folder. Boom. It's on my cell phone. It's on my computer. I can access it anywhere because it's on the cloud. I like it. Okay. I have my little seminar links. I've got it saved on Dropbox. Anybody can click it. They see exactly what I have. And all my seminar stuff, I have my videos saved on Dropbox. So if you sign up for the seminar, you can literally get access to the link for life, and all the crap's on there. The video, the support materials. I like it. I don't know. Sue me. I blame you for Jeremy pivoting to quality companies. If you just left him alone, he would have blown up on his own. He would no, dude, he wouldn't. He ain't gonna blow up, okay? If Tattooed Chef didn't take down that clown, nothing will take down that clown. Nothing. He's never going away. I think you're missing the B2B aspect of Dropbox. B2B. I mean, am I C or B? Am I C or a B? I don't know, because I'm a business. He's talking about corporations. Yeah, I mean, I like it. What are your top 10 stocks to buy for the Azure Bonnie invasion of Armenia? I am agreeing with Mike Stathis that we should be shorting his gas stocks. Where do you come up with this stuff? Okay, let's see. VTI, good ETF to buy. I don't know. You tell me. This dude's messy bedroom suggests that he's anything but financially successful. How is this my bed? Do you think this is my bedroom? What kind of crack are you smoking to think this is my bedroom? Does this look like a bedroom to you with a freaking boiler in the background? I'm going to give you one guess, everybody, where I'm sitting. Am I in the backyard? Am I in a bedroom? Am I in the attic? Or am I in the garage? Pick one. Where do you think I am? Let's see. Wrong man lost his shirt in the bear. That's right. I'm destitute. I think that is his first. It's my garage. Bankrate should have chosen Paul instead of Jeremy. Oh, that would have been hilarious. Strongman sleeps in the furnace room. Garage. He's in the walls. I'm in the backyard. That's right, Julius. You're in that's your bedroom. Yeah, it's my freaking bedroom, you clowns. Snake hanging from my wall. You want to see the snake? Oh, God. You guys like that? You got to see my abs. All right. A couple more comments and I'm closing this off. You're sitting in Jeremy's Tesla. Man, if I got inside his Tesla, there'd be lots of pee stains on it. That's all I'm going to say. Well, you can't afford a proper studio, bro. You must be rolling in dough. Yeah, that's right. You know my business is ultra profitable, okay? Because I don't spend money on garbage. Oh, you're poor. But if you wear a suit, that means you're rich. Yeah, that's why you're always going to be freaking broke. Just listen to guys that wear... Go listen to a financial advisor. I'm sure they'll set you up. They wear freaking suits, okay? It's a bedroom kitchen. I mean, honestly, if I was a single guy, I could live in here. I mean, I could have a little cot in the corner over there. Yeah. When Jeremy announces the next Carnival Cruise vacay, will you jump on? Oh, yeah. Imagine me and him on the same cruise ship. That would be hilarious. How can I get you to be my CPA? Well, I'm currently not in the business, man. I mean, if you want to learn about accounting, I'll tutor you, but like I don't have my own tax bookkeeping business. Okay. Dude has a cot in the corner. He ain't right. I want to see a snake. I'll show you a snake. If it were his bedroom, we would see Jeremy's body pillow. How much can you bench? More than you. I don't actually max out. I don't max out. Make a video on how to time the bottom. Exactly. Just when it goes down, you got to look at the stochastics. Okay. I learned this from Mo. Okay. Everything money. Sign up for Everything Money, guys. That's how you learn how to time the bottom perfectly. Okay. I think they're raising prices too pretty soon. But Mo taught me stochastics, candles, dips, buy the dip. Yep. First client, man. Yeah. I'll text you later, Andrew. VT or a Target retired fund. Well, whatever you want to do, man. I can't tell you what to buy. Is it necessary to be a CPA? I'm like, yeah. Trust me, if you have a complex tax situation, you want somebody that has experience and has some kind of credential. Okay, that's the two things: experience and credential. Let's see. Do it. I'll text you. You're giving away how to read balance sheets for free. I'm getting paid for this, man. I'm getting ad revenue. What are you talking about? You ain't rich until you have 20 chairs in every room. I'm just going to buy a bunch of chairs. Oh, I'm rich now. Let's see. $40 a month. Oh, my God. These grifters. I need to make a video making fun of them. It's been a while. All right, guys. That's it. Hope you enjoyed the video. Fartbox is Fartbox. I don't know what to say. I mean, great service. I use it. And you could see it. This is how I'm going to sell my grift. Okay. If you want a one-on-one with Strongman, there's a Dropbox link. And if we do a one-on-one, I'm not giving you stock tips. Okay. But if you want to understand accounting, you want to look at a financial statement, you must say, what's that? I'm like, oh, that's an impairment of real estate asset. That's blah, 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 blah. I will gladly do that for you. Okay. But if you want to pay me, I'm not giving you stock tips. All right. But there's a Dropbox link. Takes you straight there. You can pay me, sign up for a one-on-one, or you can buy my seminars, bro. Oh, no, I'm just a CPA. I don't know anything. Me and Jeremy are basically the same thing. He charges 20 grand. for a tattooed chef, and I charge $50 for a CPA's knowledge. You know, you choose which is a grift and which isn't. Jeremy Body Pillow. Oh, here he is. You're pretending to believe that individuals work so you can sell your low IQ, poorly educated Rube followers your scammy courses. Kid, please explain how a CPA teaching accounting is scammy. Please. I don't understand. You're trying to paint me into a box, and you're wrong. You are wrong, sir. Okay. How many times do I have to embarrass you before you just go away? I'm not going to block you because I'm worried about your mental health. If I blocked you, I don't know what you would do with yourself. Okay. How long is it going to take, Kid Freshie, before you bend the knee and call me your daddy and then kiss my freaking feet? How long is it going to take, boy? Fart box. No one is taking your scammy course to learn account. That's fine. You know what? Everybody go pay Jeremy Lefebvre. Go give Jeremy 20 grand. Don't pay for a CPA to teach you how to read financial statements. That's stupid. Pay 80 times more, 100 times more. Give it to Jeremy Lefebvre instead. That's a better way to spend your money. That's a much better way to spend your money. I have no problem with you teaching accounting. Okay, kid, send me $50. I'll give you a discount, $45, okay? $45.99. And I will give you access to one of my seminars. And you tell me if I'm teaching valuation or not. I'm just saying. Financial statements are pretty important when it comes to valuing. Yeah, I mean, you have to understand them. But it's not looking at a financial statement is not valuation. You're looking at you're looking at past transactions. You're looking at the financial performance of a company over a certain period of time. Well, the balance sheet's a snapshot. The cash flow and the income statement reflect the company's transactions over a period of time. That's it. It says nothing about the future. Nothing whatsoever. When you're looking into the future and saying, oh, this is revenue growth rate will be this and the profit margin will be this, that's where you're getting into valuation and you're trying to predict the future. Accounting is not about the future. It's about recording the past and presenting it in concise financial statements. All right, that's it. Cheers.